I'm here today with Roman Chuyan. Roman is the president of Model Capital Management, LLC, based in Boston, Massachusetts, and focused on asset allocation. Roman, welcome.
Thank you, Rob. Model Capital Management grew out of my experience in asset allocation. It is well known that asset allocation accounts for most of portfolio return and risk. In fact, for a diversified stock and bond portfolio, asset allocation accounts for about 90% of risk and return. So it became my focus over the years. However, it is still challenging to actively manage asset allocation. Even the best designed diversified portfolios are still subject to significant downside risk.
Like what happened in 2008?
Exactly. During the bear market of 2008, most stock portfolios plunged by about 50%, and even diversified stock and bond portfolios lost about 35% of their value. So investors don't want to live through that experience ever again.
So you focus on asset allocation. Why?
Because asset allocation is such a large part of portfolio return and risk, it is the best way to try to outperform and, more importantly, to reduce a risk of significant loss. So our asset allocation process includes a dynamic component. Instead of simply buy and hold strategic asset allocations, it includes a component designed to reduce significant downside risk.
So what is your approach?
Our approach can be summarized as fundamental and forward-looking. We realized early on that we needed to be forward-looking in our approach. Great hockey player Wayne Gretzky used to say, you need to skate where the puck is going to be, not where it is. And so we create our allocations based on expected returns and the risks for major asset classes.
Expected returns. So how do you figure them out?
Well, that's the key. We forecast them using our forward-looking models. Most investment advisors agree that fundamentals drive markets, and our primary equity model utilizes over 20 fundamental factors, including market valuation, how expensive or cheap the market is, and economic fundamentals, including production, consumer confidence, consumption, the housing market, and so on. So again, we are fundamentals-based and forward-looking.
How do you add value to your clients?
As for any manager, part of the value is in our performance, but investors also must consider risks. And a big part of our value is reducing significant downside risk for our clients. Also, our strategies are unique. They're not publicly available. And lastly, we build our portfolios from low-cost ETFs, which further reduces fees for our clients.
Thanks for joining us today, Roman. It's been great.
Thank you for having me.